All right. Hey, everybody. Welcome back for round 2 of the PPP Loan Guidance Debrief. We have another exciting update and list of questions we are going to tackle today for you. The layout of this webinar will be the same as our first one, where we have 40 minutes of getting you up to speed on what has transpired over the past couple weeks. And then at the end, we'll leave about 20 minutes for your questions. Please use the Q&A Zoom function to submit your questions and we'll address at the end. If we don't get to your question, we will email you like we did last time, answering it for you. Lastly, this webinar does count for CPE and you will need to respond to the survey at the end to get the CPE credit. So without further ado, I'd like to introduce our speakers, Jim Merklin and Dale Ruther. They're both partners here at BMF. Let's get into it. Jim, I'm going to start with you. Can you discuss the 24-week versus 8-week option? And as you discuss it, can you talk about if there's restrictions on which one you can choose? And is there an option to choose something other than 8 or 24?
Good afternoon, everyone, and thank you, Mindy. A couple of parts to your question. First of all, with regards to restrictions on which you choose, there are no restrictions. You can choose either the 8-week period or the 24-week period. And there are aspects, if you select the 24-week period, where you have to use the full 24-week of information, and I'll get into that in a little bit. But generally, it's one or the other. With regards to the 24-week option, there are a number of aspects to this, and it's rather confusing. So on June 22nd, the SBA issued some new, what they call interim final regulations. And it covered a number of key areas. One of the items that we've reviewed within those regulations, what it did is that it did provide clarification that a business can file for forgiveness once they've spent all the money. There's not a requirement that you wait until the end of the 24 weeks in order to be able to file. There's also in the applications that were released by the SBA, there's also a fairly vague reference to that in one of the instructions on the long form application. But it's a very vague reference, and a lot of people are missing that, which is one of the reasons why the SBA provided the clarification that they did on June 22nd. So once you've spent all the PPP funds that you've received, you can proceed to fill out the application and file for forgiveness. What we've observed is that the SBA is going to view your application date for the forgiveness as essentially the replacement for December 31 in determining your safe harbor. The safe harbor means that if you have restored your full-time equivalent employees to the same number that it was in your measuring period by the safe harbor date, then you can avoid having to do the proportionate reduction calculations that are required by under the CARES Act. And so you're really now given two choices if you use the 24-week period. One choice is being you've got a December 31 safe harbor. So if you restore employees by December 31, you can avoid that proportionate reduction calculation. The other is on your application date. So there's a little bit of strategy there. If you're looking at your application date and you haven't fully restored, and there may be some calculated amounts where you might lose some of your forgiveness, but you're looking, 2, 3, 4 weeks down the road that you expect you are going to restore that number, it may be justifiable. Just hold off on filing your application, and you may save yourself a lot of money by doing so.
All right. Thank you. Dale, you're next. Do you expect there to be interpretations that may need to be made when filing the form?
Well, cheers to everybody again for welcome back to the Q&A sessions today. And I think the interpretation part is going to be very important. There's been updating of the forgiveness application forms and the instructions. There's been, as Jim referred, continued updates on the Q&A, continued issuance of additional interim final regulations, and all those things are going to have to be interpreted when we file the loan application forms. So I think the best way I can illustrate is really, I've had clients call me up. I'm going to give you kind of 4 examples to quickly walk you through of how some of the interpretations may work. So one of them is we have a client who has both a base salary for salespeople and in addition, commissions. And if you remember on the 25% reduction calculation, you have to compare the first quarter of 2020 to the covered period to determine if there was a 25% reduction or not. So one of the questions coming up, obviously there was a decrease in the sales levels that were going on during the covered period and during the pandemic that was forcing commissions to go down. So when you would look at the calculation of the actual numbers of base salary or wage plus commissions, okay, it was going to be less than and potentially less than the 25%. If you dig back into the CARES Act actually specifies different kinds of compensation, salaries, wages, commissions, and other similar compensation in the CARES Act. And it breaks down into different scenarios. So the question is, what do you need to calculate in when you're doing the 25% reduction? So in doing some research with the client and going through some things, in the interim regs, the final interim regs on June 1st, the Treasury Department came out and said, the question became, how do you calculate? It says, I'm going to read it to you out of the regulation itself. It said salaries or wages in excess of 25% reduction will result in a reduction in loan forgiveness. Okay, this is for people that are under the $100,000. But then it defines the borrower must reduce total forgiveness amount by the total dollar amount of salary or wage reductions that are in excess of 25% of the base salary or wages between January 1st, 2020 and March 31st, 2020. Okay, so now when I read that, there becomes a question as to, is commissions part of that 25% reduction or not? I'm not sure they're going to come out with a specific question in a Q&A or anything like that. So there's going to be some interpretation that's going to have to be done. So one of the things that I believe, when you get your third-party payroll forms or even payroll forms that come off or calculations that are going to come off to help support this 25% reduction, they're going to be very mechanical. They're going to compare the first quarter of 2020 to the covered period, and they're not going to break it out between the two of them. So you might have to put in some kind of supplementary schedule if you believe you have a leg to stand on that you don't have to include the commissions. We can wait for additional regulations. We should. You're going to have to determine whether you want to take that position or not and have some support to back it up. So I think an example like that tells you like some of the rules and regulations and interpretations we're going to have to do. Another one that came up had to do with bonuses. Clients had bonuses that they calculated at year end that got paid in the first quarter of 2020. So obviously that wasn't part of the base salaries and wages. So that might be another thing that there would be a potential to exclude from the calculation of whether you have a 25% reduction or not. So that's important. On the FTE calculations, as Jim indicated, one of the things is you don't have to wait till the full 24 months to determine, or I'm sorry, the full 24 weeks to determine what the FTEs, it's the earlier of December 31st, 2020, or the date you filed the forgiveness app. So that might help you on that FTE calculation. And then a final one, we had a question that came up regarding if you have a profit sharing contribution that you're paying into the pension plan, that's a payroll cost or your profit sharing plan, and how do forfeitures get treated if you had a $50,000 contribution that was due and you had $10,000 of forfeitures? Could you consider the whole 50, even though you're only paying 40, that 10 would go towards the forgiveness? So there are going to be a number of questions that come out over the time that you're going to have to take positions on. I think it'll all depend upon how far over the forgiveness amount you are of the loan. You know, we want to make those less in terms of numbers as possible, but I think you have to be prepared to document it and determine, you know, if you need some supplementary schedules to go with that forgiveness calculation to help. Because again, the payroll, what I've seen from third-party payroll providers is very mechanical. They're just putting the numbers in, crunching it out, and giving it to you on the report. So you might want to take a few minutes in reviewing that, bouncing off any of your BMF advisors or anybody like that to help you with that. That's it, Mindy.
Thanks, Dale. You know, I think you answered this next question, but I'd like Jim to maybe drive it home here. Jim, what happens if I elect a 24-week period and then due to business performance, I decide I have to lay off employees before the 24-week period is over? Is my forgiveness allowance reduced?
So it's important to understand that you really only make this election for an 8-week or a 24-week period upon the filing of the application. There's nothing to file in advance saying, hey, I'm using 8 weeks or I'm using 24 weeks. So it's really the filing of the application that triggers all of that. But what I'm recommending to clients that they do is do their calculations as of the end of the 8-week covered period, and then really keep a close track of expenditures on a week-by-week basis, and really be prepared to file as soon as you've spent all the money. Now, over these next 2-3 weeks, we're not sure what the time frame is. That may be a little challenging because the banks really aren't ready to accept applications yet. So if your 8 weeks is already done, you've already spent all your money and you're raring to go, you really can't file your application right now anyway. And we're going to talk a little bit more about that later this afternoon. So if you're considering layoffs, it is worth the effort to model out how much you would lose on a proportionate reduction using the FTE calculations versus how much of the money have you not yet spent. Any actions you take after you file your application are not going to impact the calculations, but layoffs prior to applying could impact your calculations. It's also important to understand there are some nuances to this that are not real clear when you read the regulations. So for example, Dale mentioned the example of taking the salary reductions. If you have done salary reductions beyond the 25% that's provided for in the CARES Act, and if you've chosen to use the 24-week period of time, one of the things that you'll have to do, which made me scratch my head a little bit when I read it, but I understand what they're getting at, and that is that you would have to account for that salary reduction for the full 24-week period, even if you file early. So let's say you've spent all of your money by week 10 and you're ready to go ahead and file your application, but you have done some 30% reductions in compensation for some employees. Well, what you would do is you would take the amount that exceeds 25%, so you'd take 5%, and you would calculate that 5% over the full 24-week period, and that would be a dollar for dollar reduction in the amount of forgiveness that you have available to you. So that, like I said, that's a nuance that you have to watch out for very carefully and give consideration as to, is it worth me taking the 24 weeks, or might I be better off sticking with the 8 weeks?
Dale, can you talk a little bit about what type of documentation needs to be maintained in the file for the loan forgiveness application?
Yeah, so what happened is they came out with 2 loan forgiveness applications. There's a EZ application, I think the numbers are 3508, and then what I'll call a long form forgiveness application. And on pages 10 of the long form and page 4 of the instructions on both of those will give you the actual detail of what you need to submit. They break it down into kind of 2 categories, one being documentation that you have to submit with the loan forgiveness application, in addition to documentation that you have to create and maintain for 6 years. Upon audit, you would be provided to submit that. So you want to review those pages of the instruction, but items that you're going to need to include will include bank statements, third-party payroll reports, payroll tax reporting forms such as state unemployment forms or 941s, canceled checks, invoices for fringe benefits, and other non-payroll costs that you're claiming forgiveness for. In addition, you're going to have to include copies of leases to show that they were in effect as of 2/15 of 20, utility bills showing that there were services included or started before 2/15 of 20. You're going to need either amortization schedules or loan statements from the bank for the amount of interest that you're claiming. And then depending upon whether you're on the EZ form or the long form, on the long form, you're going to have to include the supporting FTE calculations for both, whether you had any reductions or the 25% payroll reduction calculations that we've been talking about so far. So there are a variety of supporting documentation. And again, I'll assume the idea is going to be, and Jim's going to talk about this in other questions, kind of what the review is going to look like for the banks and the SBA. So I think the objective is going to be to kind of maybe put together with the loans forgiveness applications, kind of summaries that tie back in an effort to lead the reviewer of the documentation to get to the same numbers that we are when they're done, because I don't expect they're going to be spending hours upon hours upon hours reviewing some of these things. So the more that we can make it follow and make it easier for them, I think the more logical it'll come. They'll come to the same conclusion as to the amount of forgiveness that we're asking for.
That makes sense. Jim, can you talk about strategies that we should be considering, maybe some if-then scenarios that we should be running through as it relates to when to file for the forgiveness application?
Sure. So as I mentioned earlier, you really don't have to make the election to do an 8-week or a 24-week other than when you file the application. The strategy truly circulates around what's going to get you closest to 100% forgiveness. However, there are some other considerations. For example, are there expenses that might be included in your covered period that you feel might be questionable if they were examined by the SBA or by the bank? And so by questionable, what do I mean by that? What I mean is that maybe there are some uncertainties because of lack of regulatory guidance from the SBA as to whether something is or is not included. Dale mentioned a little while ago the retirement plan contributions. There was early on after the CARES Act passed and these were just being applied for, there was a lot of question as to, hey, can my 2019 profit sharing contribution that I pay in 2020, can that be included? I think we're all a little more comfortable today that, yeah, that can be included. There are some nuances there that we're going to talk about. But it's those types of things where we're waiting on regulatory guidance that may or may not come. I think we all have to anticipate that the SBA might not issue some regulatory guidance and might make us make interpretations that they might try and challenge later on down the road. And so for that reason, I think another strategy that ought to be considered is that after you've spent the money in your 8-week period or your 24-week period, and frankly, your businesses aren't just stopping after 8 weeks. You're continuing to do your business. You're continuing to spend money. It's just not the government's money anymore. One of the strategies might be that maybe instead of using the 8-week period, maybe even if you've already spent 100% of the money after 8 weeks, maybe you go ahead and use a 9 or a 10-week covered period and you include more expenses on your application than you borrowed from the government. The philosophy behind that strategy might be if they do look at one of those expenses and they consider that to be questionable or they try and challenge you on something, that you look them square in the face and say, okay, go ahead and bounce that one. I've got another $100,000 in there that I spent on other stuff that does qualify. So I think that's something that's definitely worth giving some consideration to as you apply for these forgivenesses.
So essentially have a little bit of cushion in your back pocket to pull out in the event that they throw some stuff out.
Absolutely.
Hey, Dale, can you talk about and discuss the public disclosure of all loans over 150?
Sure. And I just saw, actually, before we got on the webinar today, that I saw a release of I think it was a press release. They said they're going to start releasing for public disclosure all the loans on Thursday. So going to the 4th of July, everybody, look for your name to be included in that if you had a loan over 150,000. So what they came to, there was a big discussion about transparency and how much was allowable versus privacy and all those kind of things. So this is kind of where they settled at. On loans greater than $150,000, the following items will be disclosed: the borrower's name, the borrower's address, the borrower's zip code, the borrower's business type, certain demographic data about the borrower. If you're a nonprofit, what kind of nonprofit you are, the number of jobs that were supported by the loan. And then it won't disclose the actual amount of the loan. Rather, it's going to break it down into different categories. Whether your loan was between 150 and 350,000, between 350 and a million, between 1 million or 2 million, between 2 million and 5 million, or 5 million and 10 million. So those are kind of be the breakouts for all of the loans greater than $150,000 and the disclosure. So the public will be able to go in and see. For loans under $150,000, they're only going to release aggregated data by industry, zip code, business type, and different demographic categories. So I think the one thing that we see coming out of this is going to be, they do want some transparency to this whole process. The other thing is I've seen already probably 4 or 5 items of people who have already been accused of or being prosecuted for misuse of PP funds already. So this is kind of, I think what they're doing here is the whistleblowers. So if you have any public people that are out there that are looking at that and saying, hey, I know Joe Schmo that owns this company, he got this loan and he happened to buy 3 more Corvettes or whatever it is, and he has some reason to believe they may open up some kind of fraud hotline or whatever, because that's the only way so far they've been able to get into some of these things where they found some of this misuse. So the transparency will be there, and the disclosure will be coming out. And again, I just found out today, supposedly they're going to have that out on Thursday of this week.
Interesting. Makes for a good weekend discussion. Jim, can you discuss the intricacies of the application and the rules for compensation regarding owner employees?
I sure can. You may want to settle back in your chairs because this is a complicated area, and there's a lot of intricacies here. The rules for owner employees differ by the types of entities that your businesses might have. So I'm going to go through the different types of entities and what impacts it will have. So let's start with C corporations. Owners and owner employees are limited to being included in compensation based on the period that they're covering. So for 8 weeks, it's $15,385 is covered. And for 24 weeks, the maximum is actually not $46,154, which would be 24 divided by 52 times 100,000. It's not that number. That number does apply, by the way, for non-owner employees. But owner employees are capped at $20,833. That number is based on 2.5 months of a year capped at $100,000. And so that is an interesting nuance. In addition, healthcare and retirement expenses are not subjected to the limitation and are above and beyond those amounts. There's also an additional condition. The pro rata compensation for owner employees cannot exceed the pro rata compensation that was included in the same period in 2019. Additionally, there's a cap on retirement plan contributions on owner employees at 2.5 months worth of the 2019 contribution amount. So, for example, if your company made a profit sharing contribution that you paid during the covered period in 2020 of $200,000, but last year with the same base of employees you only paid $100,000, you're going to have to figure out for each of your owner employees how much was the profit sharing contribution that they each individually got this year, how much was it last year, and you're going to be limited to how much they got last year out of that profit sharing contribution. So that's another interesting little tidbit that they threw in. They really did this because they wanted to avoid what they perceived to be a potential windfall for owners of companies. And that's not the message that they wanted to send to the public. So now let's go over to S corporations. Treatment for S corporations is fairly similar to what it is for C corporations. However, group healthcare expenses are treated differently for S corp owners, but only for those that own 2% or more of the company's stock, because those amounts are added back to compensation, and then those owner employees get to deduct that on their 1040s. Since those amounts are included in W-2 compensation for S Corp owners, they're limited to the compensation cap. So basically, they don't get to include, for those individuals, they don't get to include the group healthcare expense. This was clarified in the interim final regs, but it's interesting to note that this is actually contrary to a Q&A response that the SBA gave back about 2 months ago. FAQ number 7 was issued that said S Corp shareholders would get their health care included. So there's an inconsistency here, and because of this inconsistency, it's entirely possible that the SBA might issue some additional clarification on this rule. We don't know, but what we do know is what we've heard from the American Institute of CPAs, and that is that the SBA is sitting on anywhere from 25 to 40 additional Q&As that they're working on updating and hope to get some additional guidance issued. So now let's talk briefly about LLCs or partnerships. They're similar to the S Corps in that the group healthcare is included in their compensation, so those are subjected to the cap. This may be a little more limited when guaranteed payments are used in lieu of compensation to the reported self-employment income. So if you're filing a 1065, which is the IRS form for partnerships, you'll have to watch carefully as to what we're able to include for those partners or members in LLCs. Last one would be independent contractors or sole proprietors. So if you're filing on Schedule SE or on Schedule F on Form 1040, this applies to you. You would consider the lesser of, this gets complicated, it's 20.833% of your 2019 net income or $20,833 as having been spent on forgivable costs. Most of these individuals got their loans based on 20.833%. Again, that's 2.5 months divided by 12 months. Most people got their loans based on that 2.5 months of their 2019 net income, and they're going to be able to count the same amount for that same amount for forgiveness. And on top of that, they'd have rent and interest and utility costs. So one would expect that they'd be able to get their forgiveness. I hope that helps, Mindy, and back to you.
Thanks. So Jim, you covered the owner employees compensation caps. Dale, can you talk a little bit about, are there new employee non-owner compensation caps that we need to consider?
I think probably Jim covered most of them. And the employee compensation caps, again, for 8 weeks, if somebody was over the $100,000, is $15,385. For 24 weeks, as Jim referred to, it is $46,154. Jim did an excellent job going through the owner employees, the general partners, and the sole proprietors, their caps, and he explained that well. I think one of the things that we probably want to talk about on that is one of the interpretations, again, will depend on if we file early, if you elect out 24 weeks for your forgiveness period and you file before that, the question becomes, we believe at this point in time that they will prorate the caps for the employees based on the number of weeks that you have. Now, that's one of those interpretations that we're waiting for. Will it be coming? Will it not be coming? I think that's a whole nother question that we'll see coming up. And again, Jim, I think just re-emphasizing what he talked about with the benefits, depending upon the type of entity you are, whether you're a sole proprietor, a partnership, an S Corp, or a C Corp, how your hospitalization and retirement benefits get included kind of depends upon where the items flow at on your tax return. If they're on your Schedule C or part of the K1 items that they are, but most of the time they're a separate pass-through item in most of the flow-through entities, and therefore kind of knocks them out of being able to be available for forgiveness under the PPP regs.
Thanks. Let's kind of shift gears, Jim. Let's talk a little bit about the audit process. Do we have any insight as to what the SBA's audit process will be like?
So Mindy, right now, we really don't have a lot of guidance out there. We are waiting for the SBA to issue audit guidelines, and they will issue and publish that information, so everyone will be able to see that. But there are a number of things that we can reasonably expect to happen. First of all, the SBA is not likely to be doing audits during the 90 days that they have to process a forgiveness application. So under the regulations, the SBA has 90 days from the receipt of the application from the bank to process the forgiveness. And it appears likely that their process will mostly surround checking the bank's process to validate that the bank what it was obligated to do, and then funding the bank for the amount of the debt forgiven. So for example, if a company borrowed $100,000 and was eligible for $90,000 of forgiveness, the SBA would, within that 90-day period, send $90,000 to the bank. The remaining $10,000 would be amortized pursuant to the terms of the loan. That would be in the promissory note itself. A second item is that the instructions indicate that you need to save your documentation for 6 years from the date of forgiveness. This is because the SBA is going to be doing their audits during much of that 6-year period. It's important to note that while a lot of attention has been given to SBA statements that every loan over $2 million will be audited, they have the right to audit any loan. And we do anticipate that they are going to do some audits on loans below $2 million. So it's really important to maintain your documentation and have that available if you were to get audited. At least initially, it appears that the SBA's audit focus is going to be on whether the company was entitled to borrow the money in the first place. A particular note here is that the SBA has previously granted a safe harbor to companies that borrowed less than $2 million and indicated that they will presume that those companies needed the money. For companies that borrowed more than $2 million excuse me, for companies that borrowed more than $2 million, the audit's going to focus on whether the companies had sufficient need for the money. This gets back to something that we addressed in our last webinar, but it's worthy of a repeat here. These borrowers need to make sure that they've adequately documented why they felt there was sufficient economic uncertainty that justified them needing to borrow the money. If you haven't adequately documented this in your file, I strongly recommend you do so, using information that was available to the company at the time you applied for the loan. Not at the time you applied for forgiveness, but at the time you applied for the loan. Some of the things that you might want to include would be financial projections, customer or marketplace feedback that you might have had available to you, considerations as to whether you would or would not be looking at laying off employees if you didn't get the money. Those types of things would be really important to include in that documentation. It's important to be able to demonstrate that you took certain actions to mitigate impacts to your employees as a result of having received the PPP funding. That's really what the SBA will be looking for. Now, that's not the only thing they'll be looking for in an audit. Certainly they'll be auditing the forgiveness calculations themselves, but we do believe that that's going to be a principal area of focus because there's a lot of political attention that's been paid to the PPP loan program. Due to other safe harbors that the SBA has published, they're not in the vast majority of cases going to be looking to impose significant penalties on companies or individuals. If they determine during their audit that you really didn't need the money, they're going to give you the opportunity to pay it back. From what I've read, the penalties would really only seem to apply in circumstances where the SBA made their determination that the company did not need the money, company refuses to pay back the money, and decides that they want to fight the SBA. Then the SBA will have the issue of penalties that they can hang over a borrower's head and say, hey, if you don't stop arguing with us, you could be subjected to these penalties. Doesn't mean that that you will be subjected to them, but just understand that they have that as a tool in their tool belt. And if you do get into a fight like that, that's really where I would recommend getting your legal counsel involved to assist to make sure that you're taking proper legal protections of your positions.
Gotcha. We're going to shift gears just a little bit. Dale, can you briefly discuss the double dipping concern as it relates to nonprofit organizations?
Yeah, so as it relates to nonprofits, whether you're on our call now is representing the finance department of nonprofits, or maybe you're on the board of a number of nonprofits. One of the focuses that I have found interesting, and we're going to see how it all plays out over time, is this concept of double dipping. And what they indicated was that clients who get federal, state, or they expect state and local sources, if you have a cost reimbursement contract such that you provide a level of service or some kind of item such as group counseling or something like that, and you get paid via grant, so that on a monthly or quarterly basis, you submit wages and certain other expenses, could be utilities, rent, overhead calculations, things like that, that then is reimbursed to you, okay, on a quarterly basis, dollar per dollar, that they say that the PPP monies cannot be used for the same purpose. So if you have wages from that program that are allocated to that program, you can't ask for forgiveness if you got a PPP loan. So what you really need to do as a nonprofit is making sure you're analyzing the kind of funding sources, where your money's coming from, to understand what potential impact there would be on this double dipping. In addition, you need to really distinguish between what's called an exchange transaction or a contribution or a grant. So an exchange transaction would be one whereby it's a Medicaid or there's a reimbursement based on a daily or an hourly basis, and you get reimbursed that amount. So it's not specifically for all of your wages and all of your other overhead expenses, versus a grant or a contribution, which is a specific allocation of specific items. So you're going to need to spend some time analyzing those funding sources to get an idea of what it is, and then what will qualify for the PPP loan forgiveness. Some of the suggestions have been, you may want to talk to the funder of the grant to understand what is their position on PPP dollars, because you're not only getting audited by the PPP loan, you're getting audited by the grant recipients, or the grantor also, or the state. They're going to come in and they'll be looking for double dipping. So you may want to talk to the funding sources and understand what is their position on these. You may ask them for an extension of the grant for a longer period of time, so that you're getting reimbursed the PPP dollars during the covered period, and that they gave you an extension on the grant. Therefore, it would cover post PPP or covered period expenses. So you'll want to spend a couple minutes going through that for the nonprofits and understanding that, because again, I think the bigger risk there is going to be on the auditors from the grant programs, even more than the PPP programs going forward.
And Dale, a complication to that is that this guidance really was not available or clear at the time when these not-for-profits were actually filed and applied to get their loans in the first place. So they might have just used the 2.5 months of compensation, not knowing that some of that compensation would not count. And so what you may find in practice is that some of these nonprofits may need to use more than the 8-week period of time to be able to spend all the money.
That is correct.
Thanks, guys. Yeah, I know we haven't spoke much about the nonprofit world, but it's an important sector, and Dale's our guru here at Bober Markey. So if you have any further questions on the nonprofit world aspect of this, please feel free to reach out. Jim, can you discuss the rules that the banks have to comply with?
Absolutely. I think it's important that everybody understand the rules that the banks have to comply with, because that's going to indicate where some pressure might come from them when it is that you're applying for the loans. The banks have been in a holding pattern for quite some time now before they can't even accept applications for forgiveness yet, because they were waiting for guidance from the SBA. On June 22nd, they finally did get some guidance from the SBA. I wouldn't say that they've gotten everything that they want. In fact, what I've heard from a couple of bankers that I've talked to is that there's still a number of areas where they need some clarifications. And I think different banks are treating it in different ways. I think some of the banks are preparing for being able to accept applications, even if they don't get additional clarification on certain points that they need from the SBA. And if they do, they're going to have to make interpretations, just like all of us are having to make interpretations without having guidance. But again, on June 22nd, the SBA did finally get some feedback. I'm not going to comment as to whether those are sufficient again, we'll leave that to the banks to determine. In the long form application for forgiveness, the banks are going to be required to confirm that they've received the borrower's certification, which is part of the application itself. So if you filled out a complete application, that should be easy for them. They're going to have to confirm that they've received the documentation that the borrower is required to submit to substantiate the payroll or non-payroll costs, which would include the breakdowns of owner versus non-owner compensation, any non-cash compensation, things like that, in order to be able to confirm the borrower's calculations by reviewing the documentation that's submitted with the application. And the bank's going to have to confirm that the borrower made the calculations correctly and that the payroll costs were at least 60% of the amount applied for forgiveness. In the easy form application, it's fairly similar requirements, but perhaps a little less detailed. The banks are going to be required to confirm that they've gotten that borrower certification, that the documentation the borrower is required to submit to substantiate the payroll or non-payroll costs is included, that they have to confirm the borrower's calculations by reviewing the documentation submitted with the application, and they have to confirm that the borrower made the calculations correctly, and again, they have to confirm that the payroll costs were at least 60% of the applied for forgiveness. Ultimately, the way the regs were written up, the borrower has the responsibility for accurate calculations of forgiveness, and the borrower has to attest to those calculations. The lenders are expected to provide a good faith review of those calculations and supporting documentation. The borrower cannot receive forgiveness without submitting all of the required documentation to the lender. And so if you file your application and there's information that is needed to substantiate it, and you haven't given that to the bank, don't be surprised if the bank comes back at you and asks for that, because the bank's going to be held accountable if they don't have that information available to them. Because ultimately, they're going to have to turn all that information over to the SBA. The bank will have 60 days after they've received a complete application to issue their decision on forgiveness. Now, I want you to listen to the words I just used very carefully. 60 days after receipt of a complete application. So if you file your application and you don't give them the documentation, technically, I don't believe that that's a complete application. And so their 60-day clock hasn't really technically started until they have all of that documentation. So it's going to be really important as you file that application to make sure that you're giving them everything that they need right out of the gate and get that 60-day clock going. The lender can render an approval, and they can render an approval either in whole or in part. They don't have to give you a complete approval for forgiveness. They can do a partial forgiveness. They can also deny forgiveness, or they can give you what's called a denial of prejudice due to a pending SBA review of the loan. So in that latter case, where there's a denial without prejudice, the borrower may ask the lender to reconsider unless the SBA has determined that the borrower is not eligible for the PPP loan. So this denial without prejudice may occur because the bank has significant concern as to whether the borrower is eligible to receive, and so the banks may defer that decision by pushing it over to the SBA and making the SBA make that determination. The lender ultimately issues its decision to the SBA, and when they issue their decision to the SBA, they're requesting payment from the SBA. The SBA has 90 days after they have received the application in order to be able to issue the payments to the bank. So again, it's not the SBA in most cases that's going to be making the decision as to whether you get forgiveness. It's going to be the decision of the bank. And the bank will ultimately render the forgiveness, but understand that any forgiveness that you get is going to be subject to future audit. So just because they've forgiven a $3 million loan doesn't mean that it can't come right back at you later if you get audited and the SBA determines that you really weren't eligible for the loan in the first place.
Great, thank you. Yeah, and I think you're right. It depends on the lender. Each bank is probably going to handle it a little bit differently. I know we were told by a client that their lender's only accepting PDF, no Excel, which I thought was pretty fascinating. But yeah, reach out to your lenders, see what their process is going to be. I wouldn't assume anything. For the last question here in the first segment of this webinar, this is for Dale. Dale, is there anything else on the application that you think is important for us to know about?
Yeah, I think really just kind of quick distinguishment. As we said at the very beginning, there's really two loan forgiveness application forms, an easy form and what I'll call a long form. They're 3508 EZ and 3508. To use the 3508 EZ, you have to meet one of these three items. You have to be self-employed with no employees, okay, which were included in your original borrowing application. So if you're self-employed and you had no employees in the original borrowing application. The second way you can use it if you did not have a 25% reduction of any of your employees compared to the first quarter of 2001, and you did not have any kind of reduction in the FTE number between 1/1/20 and the end of the covered period. So to simplify that, you had nobody under the 25% reduction compared to the first quarter, and your FTE reduction is at 100% because you had no reductions in FTEs. And the last one that you can use the EZ on is if you did not have a 25% reduction and you couldn't get back to the same level of employees because of COVID, things that were coming out relating to requirements of HHS, CDC, OSHA, anything like that in terms of safety, social distancing, any of those type of things. So if you meet one of those three contingencies, okay, or criteria, I should say, probably number two is going to be the most applicable there, that you didn't have the 25% reduction and you had basically the same FTEs. You're going to be able to file the EZ form, which is substantially less in terms of documentation and breakdown of the documentation than the 3508 itself. If you don't meet those, you're going to have to fill out 3508, complete the whole form. They have a Schedule A for PPP in addition to that, which breaks the payroll into a variety of different categories, less than 100,000, more than 100,000 owner employees. And there's a little bit more, detail that's going to be required on that. So that's really, if you can get under the EZ, it will be much better. So, but that'll focus on the FTE 25% rule and the reduction of FTEs.
Hey, Dale, if I can add one thing to that, I think it's important to remember that while you may not have to, if you're able to qualify to file the EZ form, you may not have to file the details of the owner's employees. You may not have to file the FTE schedules, but you still need to have that included in the documentation that you retain, because if you get audited, they may challenge that.
Yep.
All right, guys, let's spend the rest of the time going through these Q&As here. I like the first one. What happens if the SBA loan auditor, with the benefit of hindsight, determines that the economic need for the loan wasn't as great as the applicant anticipated when the loan application was filed? In other words, the applicant expected a bigger market downturn than what was ultimately materialized. Do we have any insight as to what the impact would be?
Well, you know, it's a great question, Mindy, and there's not a clear answer. Because the SBA hasn't issued their audit guidance yet. You know, the loan application and the facts that existed as of that time are what needs to be given consideration as to the issue of economic need. I mentioned before the need to make sure that you've got adequate documentation in place. Here's where that's going to come into play. Because your crystal ball that you had at the time you filled that application out is going to be a heck of a lot better than anything that the SBA is going to be able to throw at you. So all you can do is identify what did you know at that time. And I think it's going to be very difficult for the SBA in an awful lot of circumstances to provide evidence that a company didn't have an economic need when there was uncertainty. At the time that people were taking out these loans, we were, you know, a few weeks into this global pandemic, and people really didn't know what effect this was going to have on their customer base. They didn't know what effect it was going to have on their ability to get workers to come and do work on projects that needed to get done for them. That careful documentation of what was happening at that time is going to be extremely important to being able to demonstrate that what happened later, even though maybe it might not have been as bad as you anticipated, the documentation that you prepared at that time will be critical to demonstrating your case and arguing against the SBA.
Yeah, I think the only thing I'd add on to that Jim has, maybe some examples that I see, would be the fact that, let's say we have clients, I have some clients in the construction business. So the construction business in Pennsylvania got closed down. Ohio didn't. So you had no idea what was going to happen. To Jim's point, when you filed the application, you had no idea what was going to happen. They could close down construction in Ohio like they did in PA. So I think it's those kind of things you want to document and put together as to what your thought process were at the time. Same thing. We had, you had a bunch of municipalities that were going to lose revenues. They may start cutting back on contracts that they had in terms of that. Restaurants I had that were clients, they had no idea what kind of level of business they were going to get from carry out business versus in store with the stores being closed. So anything that you can utilize to document, what that uncertainty was, how that transpired going out, now that we're, whatever, 8 weeks into it or 10 weeks into it now, however it impacted you, you didn't know 8 or 10 weeks ago. Your sales level, may have been at 75% or 80%. It could have very easily been 30%. So I think anything like that supports it would be important to kind of document in your economic certainty memo, if you will.
Again, the only other point I'll make is just repeating what I mentioned earlier, and that is if you borrowed less than $2 million, you get a hall pass because the SBA did give a safe harbor for those companies that they're not going to challenge.
Okay. On that, Jim, if you use 8 weeks and not 24 weeks, are there similar safe harbors in place to restore headcount?
So the original rules that, as far as the safe harbor, was June 30th. The new regulations and the Flexibility Act changed that to December 31. But as I mentioned before, the safe harbor now is going to be on the earlier of the date you apply for your forgiveness or December 31. If you've restored your employees to 100% by that point in time, and that's both the FTE count as well as bringing people back up to, doesn't have to be their original wage, but at least less than a 25% reduction, that's going to be the safe harbor. So it's really either December 31 or the date that you file your application. And the same thing really applies for the 8 week period, because June 30th doesn't exist anymore in the rules. Even if you follow just the 8 week, you're going to be looking to the date you apply as your safe harbor date.
Okay. And I think, Dale, you might have tackled this one earlier as it relates to support, but do you have to submit quarterly 941 and or state quarterly unemployment form for verification of payroll with the forgiveness application?
No, I think what you have to do is you have to take, I think it's some kind of support like that, or the actual payroll registers that show you maybe get the taxes impounded every payroll. And then again, you're going to have to put together some kind of summary sheet that's going to tie up your covered period, because the covered period and the tax forms aren't going to all sync up exactly right. So I would expect it to be more related to the payroll tax registers that you are getting from the payroll registers from the third-party payroll. If you do your payroll internally, it's going to be taking those tax forms and kind of, I guess, if you will, reconcile them to your covered period.
Okay. This is a good one. One of the full-time employees retired on June 6th. This was planned before March. How do I count this employee? And since there was a reduction in payroll, will this be part of the 25% reduction?
That's actually a fairly easy one. You don't have to count that employee. So you're allowed to exclude from the FTE calculations individuals who voluntarily separated from the business, individuals who were terminated due to performance or for cause. So retirements would be included as a voluntary termination and would not count against you.
Gotcha. The next one is, it is my understanding that there are no prepayment penalties. And if elected to do so, a company can repay any unforgiven amount at one time. Is this still accurate?
Yes.
Yes.
Okay. Given the transparency provided by naming of entities who are getting loans and their range of loan dollar, how does the often quoted $2 million threshold factor in the amount of scrutiny of forgiveness, or is it still a factor?
If I hear that right, I'll take a shot and Jim can fill in. I don't know that the forgiveness, I think, again, I think the idea of the public disclosure piece of it is really to get the whistleblowers. Again, as Jim said during some of his earlier comments, I think the two things they're looking for are fraud, flat out fraud, fake documents, misuse of funds for personal expenses. And the second thing, and we said this before, is inurement of benefit to the owners or highly compensated employees. So I don't think they're necessarily on the public disclosure really looking to catch anything that something was wrong, whether you should have got the loan or you shouldn't have got the loan or whatever. It's really going to be more of, the best way to catch fraud. Mindy's in our evaluation group and the rest of our group, Steve and Mark, best way to catch fraud usually is not by audits, but rather by whistleblowers and people who are internal. I wouldn't even put past them setting up some kind of a hotline at some point in the future to say, hey, if you have something, you want to leave it anonymously, or you believe something's wrong, they're going to do that. So I think they're really focused on those areas rather than the disclosure. I mean, it is what it is. I'm not overly worried about it personally.
Okay. Can you confirm whether commingled funds is an issue or not? Do you have to have a separate account just for the PPP funds?
No, it's not a requirement at all. There's nothing in the regulations that said that you need to segregate those. When we've talked to our clients about the PPP funds coming in, we've recommended it as a best practice so that they have a very careful tracking as they're going along as to how they're using those specific monies. But no, it's not a requirement.
Okay. To achieve the safe harbor for employee count, do we have to be at 100% or can it be at 75% at December 31st or the application date?
For the actual number, you have to be at 100%. The 25% is the salaries have to be at least paid 75% the average salary or wage in the covered period as it was compared to the prior quarter, which would most likely be the first quarter. So the 25% reduction only applies to the salary or average salary or wages, not the FTE. The FTE's got to be at the same.
And I would stress on the measuring stick with regards to salaries, that is measured on an individual by individual basis. So if you're underpaying Joe if you reduce Joe by 40%, but you've taken Sam and increased him by 20, you don't get to average the two of them together and not lose anything.
Okay. How does the SBA's EIDL loan impact the forgiveness of the PPP loans?
The part that I know of is that the $10,000 grant, okay, goes over onto part of the forgiveness piece of it if you got those dollars. So that gets moved over into the PPP loan piece of it at this point in time. Other than that, I'm not sure there's a lot of interplay on the EIDL from what I've seen so far, although I don't have a lot of clients that utilize that program. I don't know, Jim, if you have any more.
I haven't had any, but what I've read in the regulations is that there were companies that took out the EIDL loans before the PPP loans became available with the intent and expectation that the PPP loan would essentially refinance all of that EIDL. And so the expectation was that those proceeds were going to be used after forgiveness to pay back the EIDL, all except for the $10,000, which was the grant piece of it.
All right, we have one last question that we're going to be able to tackle. And I think, Jim, this might be yours. Can you explain one more time about the amount of payroll on S-Corp owner employees that is taken into consideration? So S-Corp.
Yep, so S-Corp owner employees, you're going to use the base compensation for those individuals plus any salaries and bonus to a cap of $100,000. So same definition of payroll. However, in those individuals, their group health coverage, if you own more than 2% of the S Corp, the group health coverage gets added into your W-2. So that will be treated as part of your compensation. Therefore, it will be subjected to the $100,000 cap. So basically, you lose the ability for those individuals, again, the 2% owners of S Corps, you lose the ability for them to be able to include the group health care for those individuals as forgivable expenses.
And
All right.
you had the 19 limit though too, right, Jim? The 2000.
That's a secondary
compensation.
limit. Yeah.
Yeah. So you can't be greater than the same period in 2019. One of the things they were looking for is many times we have clients who have spouses or somebody else on the payroll to get their 401k pumped up or something. So if I have a spouse or somebody in the attribute, that's an owner. I'm not sure I know what the owner is, but let's just say you had them on there for $30,000 a year. You can't all of a sudden pump them up by $69,000 of compensation during the covered period of 2020 and get it limited to the period of coverage back in 19. So there's another limit, I think, on that 2019.
All right. Well, thank you for that. And I appreciate everyone letting us go 1 minute over. If you have any questions, you have our emails. Please feel free to reach out. I'm sure we'll have more content coming up as more Q&As get released by the SBA. So thank you for joining us. Jim, Dale, thank you for all of your good insight. Appreciate it today.
Thanks, everyone.
Bye.
Take care.